The macroeconomic backdrop for insurance companies continues to generally be positive in the U.S., while at the same time, things in the rest of the world are not going quite as well.
It had a very strong second half of the year following a relatively weak first quarter. And looking ahead, I expect growth around 3% in 2015. That kind of growth should be enough to create job growth and keep downward pressure on the unemployment rate. At the same time, inflation should stay well contained within the Federal Reserve's target of around 1.5% to 2.5%. I think it's important. I think the U.S. economy actually has kind of turned a page, and the fears of a backslide or a double-dip recession have somewhat abated after kind of several years of pessimism following the Great Recession, despite the numbers telling us we've been in a recovery for some years. We see consumer confidence and business confidence up back to pre-recession levels, and the dropping gas prices really add significant amounts of disposable income to the U.S. consumer. At the same time, other industrial countries haven't been experiencing the same type of growth. Europe still struggles with high unemployment in the 11.5% range, stagnant growth, and the same is true in Japan. Well, I think monetary policy, both in the U.S. and globally, is going to be a big story in 2015. I do expect the Federal Reserve will raise rates at the end of this year, and while I think the global economy, the slowing in the global economy, will play a role in their decision making, I don't think it'll be enough to stop them from starting the long process of getting rates back to a more normal range. It should be noted, though, that this divergence in policy we're going to see over 2015 does pose a risk, and it's something we're watching pretty closely. We expect the U.S. monetary authorities, the Federal Reserve, to begin tightening, raising rates. And at the same time, the European Central Bank and the Bank of Japan, they're going to continue loosening, including giant quantitative easing programs of their own. I think there's several market forces playing all together to bring down government bond yields. First, the Federal Reserve still has a 0% Fed funds rate target, 0 to 0.25%. So that obviously brings rates down. But also, with European growth where it is, along with the fiscal austerity, there's not really many great options for investors. Emerging markets have slowed, and the credit spreads you're getting on those kind of investments are relatively limited. And all those forces have kind of pushed investors towards government bonds. And at the same time, inflation remains a non-story with inflation expectations well anchored in the 1% range. The strong growth that we're seeing, the falling unemployment rate will put upward pressure on wages, and we see capacity utilization way up. Those will all actually work to put upward pressure on prices, not downward. But with that said, I think the outlook for the next year or two certainly is relatively low rates. We think rates will pick up only modestly over the next year or two. And so that has led some insurers to explore other investment opportunities in a reach for yield, particularly the area of alternative investments, including hedge funds, private equity. At this point, the size of the allocation has been relatively modest, and it's really being undertaken by companies with strong ERM programs, sophisticated investment departments that really kind of understand the risk they're taking. We are monitoring it very closely, and what would give us concern is if we saw the size of the allocation relative to capital increase significantly, and or companies without the sophisticated investments began entering into investment vehicles where they didn't really understand the risk that these investments pose to the company.
We'd like to thank AM Best for their contribution to our program. If you'd like to see more of the First Monday series, visit the AM Best website.